This week didn't look dramatic on the surface, but the data underneath the market is starting to shift in a way that could determine the next major move. Because right now, this isn't about headlines, it's about numbers, and the numbers are starting to tell a very clear story. The first thing to understand is interest rates, because they're still controlling everything. Right now, the 10-year Treasury yield is sitting in the mid-4% range. That's important because just a year or two ago, growth stocks were being valued in a much lower rate environment. At these levels, borrowing costs stay high, mortgages stay expensive, and companies have a harder time justifying premium valuations. At the same time, inflation is still not fully under control. Recent data shows core inflation running around the 3% range, still well above the Fed's 2% target. So, what does that mean? It means the Federal Reserve is not under pressure to cut rates aggressively yet, and the market knows that. That's why you're seeing hesitation instead of momentum. Now let's look at what the market is actually doing beneath the surface. Because on the surface, things look fine. The S&P 500 is still hovering near highs. But when you zoom in, the picture changes. Market breadth is still weak. That means fewer stocks are actually participating in the move. A small group of large-cap names is holding the index up, while a large portion of growth stocks are still well below their highs. This kind of setup doesn't usually last forever. It typically resolves in one of two ways. Either the rest of the market catches up, or the leaders eventually pull back. Now here's where things get interesting. The market is currently pricing in a slow improvement, not a recession, but also not a strong acceleration. That's why volatility hasn't gone away. It's just compressed. So let's talk about what happens next. Based on the data we're seeing right now, over the next 3 to 6 months, everything comes down to one variable: the direction of rates. If inflation stays sticky and the 10-year yield remains around these current levels, you're likely going to see a sideways market. The S&P 500 could stay range-bound, growth stocks continue to lag, and capital stays cautious. That's the slow scenario. No breakout, no collapse, just frustration. But if inflation continues to trend down and yields start dropping back toward the low 4% or even high 3% range, that's when things change quickly. Because historically, when yields fall, valuations expand. And when valuations expand, growth stocks don't move slowly, they reprice. That's the key point most investors miss. Markets don't always move gradually. Sometimes they sit still, and then move all at once. Right now, the market is positioned cautiously. It's not fully defensive, but it's definitely not positioned for a strong upside surprise either, which means if the data starts coming in better than expected, the reaction could be much stronger than people are prepared for. So where does that leave the opportunity? Right now, the smartest positioning isn't chasing what's already working, it's preparing for what could change. The biggest opportunities tend to show up in areas that were hit hardest by rates, because those are the areas that benefit the most when conditions shift. At the same time, companies that are improving margins, controlling costs, and showing real operational strength are the ones that tend to lead the next phase. And then there's the most important category: stocks where sentiment is negative, but the long-term trend is still intact. That's where mispricing happens. That's where the market is usually wrong. So here's the real takeaway. The data right now is not signaling a collapse, it's signaling a transition, and transitions are where positioning matters the most. This is why I focus on the bigger picture, not just daily price moves, because the biggest opportunities don't come from reacting to the market, they come from understanding where it's going next. And right now, the data is starting to point toward a shift. If you want to stay ahead of it, follow the Fall in Growth series.